Hello, good evening. Hello, hello, can you hear me? Hello, can you hear me?
Hi, yes, I can hear you.
Okay, let's just give others maybe 1 minute, maybe they'll join the class.
Okay.
Okay, I think we can start with the class. They will find us on the way. Let's start with the class. So let's look at the question that we have. Remember, for now, we are focusing on questions. We are focusing on questions. So let us look at this group accounts. Right, when you are reading a question, what I would advise you to quickly pick, especially from group accounts, is the standard. Which standard is applied in the question? Is it International Financial Reporting Standard 10? Is it AIS 28? I think these are the standards that we use most in our group accounts. So it's very important for you guys when you are reading your questions to see, does the question requires me to apply International Financial Reporting Standard 10, or does it requires me to apply International Accounting Standard 28, so that you know how to consolidate your group accounts. Right, so let's look at the question for today. They say the following are the trial balance of June Limited, Crow Limited, and Bear Limited for the year ended 31 March 2017. So these are the trial balance. We have three companies here. Then when you are answering question for group accounts, you are guided by the notes. The notes are the ones that tells you what to do. So let's check on the notes. So additional information says, number one, it says, June Limited acquired control. This is a keyword that you should pick when you are answering your question. They acquired control of Crow Limited on 1 April 2015 by acquiring 40,000 ordinary shares in Crow Limited when the retained earning of Crow Limited amounted 349,000. The assets and liabilities of Crow Limited were fairly valued at the date of acquisition. The keyword is here. This is a word that tells you whether you are going to use AIS 28 or International Financial Reporting Standard 10. So if there is control, then it means we're going to apply International Financial Reporting Standard 10 here. So which means we're going for this, for June Limited, we are going to, for Crown Limited and June Limited, we are going to use the acquisition method. So this is how you identify which method or which standard are you going to apply. They acquired control, so which means we are going to use the acquisition method. Then number 2 says June Limited acquired control, another control, so which means we are going to use the acquisition method again. It's going to be the acquisition method. So every time when you are reading this consolidation, look at the word control or significance influence. If they talk of significant influence, then you know you are going to apply International Accounting Standard 28, which is going to be the equity method, the one that we did in our previous class. So these are the keywords that we should always pick. If there is control, then it's International Financial Reporting Standard 10. If there is significance influence, then it's going to be International Accounting Standard 28. Right, so let's look at here. So they say June Limited acquired control of Bear Limited on 1 April 2016 by acquiring 15,000 ordinary shares in Bear Limited. The assets and liabilities of Bear Limited were fairly valued at the date of acquisition, except for the land. A sole appraiser valued the land at 300. This was 54,847 above the original price. So this is what happened at acquisition. At acquisition, right, so let's look at the next part. So number 3 says, during the year ended 31 March 2017, Crown Limited sold inventory to June Limited for 18,000. The inventory was still on hand on 31 March 2017. Crow Limited sold the inventory to June Limited at a cost price 20%. Remember, we're using the acquisition method. So which means we are going to eliminate the full intra-group unrealized profit. If we are using the acquisition method, we eliminate the full amount of the unrealized profit. So which means here on number 3, we are going to have unrealized profit in intra-group sale. That's number 3. Then number 4 says, on 1 April 2016, Crown Limited acquired a 5% interest in said Limited for 40,000. On 31 March 2017, the investment in said Limited was revalued to its fair value of 45,000. So this one is not going to be part. Remember here we're looking at June Limited. So the acquisition by Crown Limited is only going to include the investment in said Limited. Is the only one that we are going to take here, the investment in said Limited in our consolidation. Then let's look at number 5. Number 5 says During the year ended 31 March 2017, Crown Limited paid 5,000 interest to June Limited. The interest was charged on a short-term loan from June Limited to Crown Limited that was repaid. So this one is an intra-group transaction. It's a loan between the group. So any interest that was received is an intra-group transaction. Remember, according to the acquisition method, we say we eliminate intra-group transaction. So which means this one is going to be eliminated. So when you eliminate, it means you go and look when Crown Limited paid interest to June Limited. So which means for June Limited, it's going to be in other incomes. Then in Crown, it's going to be in finance charges. So when you do your consolidated statement of comprehensive income, it means you need to adjust here. In other incomes, you need to reduce by this intra-group transaction. And in finance charges, you also have to reduce by this intra-group transaction. Right, then number 6 says, during the year ended 31 March 2017, Crown Limited paid management fees of 10,000 to June Limited. The management fees paid by Crown Limited were included in other expenses, and the management fee received by June Limited included in other incomes. So this is also an intra-group transaction. Crown Limited paid to June Limited. So it's going to be an intra-group transaction. So which means you also have to eliminate before you combine everything. So you go to your other expenses, then you take out other expenses by this amount. Then you go to other income, you also reduce other income. That's the complete double entry. Because in the other hand, it means other expenses must be reduced, then other income must be also reduced. Right, so that's on number 6. Then on number 7, they say Crown Limited classify its simple investment in equity instrument at fair value in accordance with International Financial Reporting Standard 9 financial instruments, and the fair value adjustment are recognized in the mark-to-market reserve. Mark-to-market reserve, you take it to the statement of change in equity. These are other comprehensive incomes. So which means if the question requires you to do the statement of change in equity, and there is other comprehensive income in your question, then you have to take to the statement of change in equity under mark-to-market reserves. We'll see if they are there. Right, then they say the June Limited Group elected to measure non-controlling interests in their proportionate share of the acquirer's identifiable net assets at acquisition. Here you should know the two methods of measuring non-controlling interest. We have two methods. One, which is the net asset value of the acquiree at the date of acquisition, and then the other one is the fair value. So those are the two methods. And when you are doing your non-controlling interest, you must know that if you are using the fair value, then it means you are going to have goodwill for the parent and goodwill for the subsidiary. But if you are using the proportionate share of the acquirer's identifiable assets, you only have goodwill for the parent. So you should always check this information before you do your consolidation so that you know how are you going to measure non-controlling interest. Then number 9 says the SA normal tax rate that's the tax rate, and capital gain tax is 80%. Here you should know where do you apply the 80%, which figures to apply. If there is revaluation surpluses, that's where you apply this figure. Then they say each share carries one vote, and the each share capital of all the entities in the group remained unchanged since 1 April 2015. So the first part of the question is saying, that is our A, discuss the accounting treatment of a gain from bargain purchase that arise as a result of the acquisition of an interest in a subsidiary during the current year. So we need to discuss how do we account for a bargain on purchase. I think that's what the question requires us to do. So that is going to be our A. How do we account for, remember we have two, is either we can have goodwill or gain on bargain purchase. So how do we treat the gain on bargain purchase? Goodwill, we take it to the statement of financial position as a non-current asset. If there was goodwill, it means we're going to take it to the statement of financial position as a non-current asset. If there is a gain on bargain purchase, what do we do with the gain on bargain purchase? We take it to the profit and loss under what? Under other incomes. So if it is a gain on bargain purchase, we take it to the profit and loss under other incomes. If it is goodwill, we take it to the statement of financial position under non-current assets. So that is our A. Then let's look at B. B says prepare the consolidated statement of profit or loss and other comprehensive income of the June Limited Group. We want the statement of the consolidated statement of profit or loss and other comprehensive income. So that's our B. So let's see how do we do B. So this is going to be our B. The consolidated right. So let's see how do we treat B. Let's see how do we treat B. Where do we start with our B? We want to do the consolidated statement of profit and loss. Where should we start with B? Let's check from here. Like when you are doing the consolidated statement of profit and loss, what you should focus much on is the additional information, intra-group transactions that affect the profit and loss. Who are those intra-group transactions that affect the profit and loss? Number 3, this is an intra-group sale. It means it's going to affect the profit and loss. Then who else is going to affect the consolidated statement of profit and loss? Number 5, intra-group interest is going to affect the profit and loss. Then number 6, the management fee is also going to affect the profit and loss. So this is where we start. So which means we are going to have the sales for the 3 divisions. Then we adjust those sales with, so let's go to our question and look at the sales figure. So which means when we consolidate, we start from here, from our revenue. So the revenue for here is 840 plus 248 plus 190. Then we adjust with the intra-group transactions that need to be eliminated. Right, so let's go and see how do we put it on paper. So the intra-group transaction that we are going to use first is number 3. During the year ended 31 March, Pro Limited sold inventory to June Limited for 18,000, and the inventory was still on hand at 31 March. Pro Limited sold the inventory to June Limited at cost plus 20%. So that's the first intra-group transaction that is going to affect our sales there. So let's see how do we put it on paper. So it means we are going to have our sales, our revenue is revenue. So in our revenue, we are going to have 840,000 plus 248,000 plus 190,000. What are we going to do with the intra-group sale of 18,000 under revenue? We minus it, am I correct? Are we together? It's an intra-group sale that has to be eliminated. So which means it's going to affect our revenue and the cost of sale as well. So we need to affect the revenue and the cost of sale. So how much are we going to have here? We just come and say this and minus 18,000.
It's 1,260,000.
1,250,000.
260,000. 260.
260. Okay, 260,000. So this is going to be the revenue. Then from our revenue, we have to go to where? To cost of sale. Right, so we go to our question and look for the cost of sale. So our cost of sale is 504, 149, 85, 500. So that is going to be our cost of sale. So we can go and fill in our cost of sale. So the cost of sale is going to be 504,000 plus 149 plus what? Plus 85, 500. What are we going to do with the intra-group sale? How is it going to affect our cost of sale? So we're also going to minus the 18,000. And also, what else is going to be affected on the cost of sale? The unrealized profit. So we're also going to minus 18,000 times 20 over 120. So this one we're going to plus it. Remember, when we do our journal, to eliminate this unrealized profit, we say we debt cost of sale and credit inventory. So which means here we are going to add the cost of sale, because in our journal we debt the cost of sale. So it's going to be how much this one? It's going to be 20 over 120 times 3 times 18,000, which is 3,000. Am I correct?
Yes.
So here, I know in the exam, there is no time for you guys to do the journals first. Because sometimes they say you can put your journals as your calculations. But as we are only going to have a calculation for the analysis, when we go down, by the time when we need the analysis, we are going to do the analysis of honors equity. But for journal entries, I think you should understand them. Like if there is an intra-group unrealized profit, then you should just figure out the journal entry. The journal entry to eliminate unrealized profit is you debt cost of sale, then you credit what? You credit inventory. So which means when you come here to your consolidated statement of profit and loss, your cost of sale you are going to add. Then when you go to the statement of financial position, then it means under inventory, you are going to reduce the inventory by the amount of the unrealized profit. So those journal entries, you should know them so that when you are dealing with the transaction, you just figure out the journal entry in your head. How will the journal entry look like? So how does it affect here? I think if you put it that way, it's going to be a bit easier when you do your consolidation. And another thing is to quickly pick, am I dealing with International Financial Reporting Standard 10? Am I dealing with International Accounting Standard 28? If it was 28, all these We're not going to bring them here. Remember, they will be represented under investment in associate, share of profit in associate. So all these intra-group transactions were not going to come in because they will be under the share of profit in associate. Right? How much are we going to have there? It's going to be
723,500.
723,500. Right. So this is our 723,500. So which means at the end now we need the gross profit. We now need the gross profit. We just subtract from there. How much are we going to have there?
536,500.
500. Then from gross
Yes.
profit, what do we need after gross profit? Other incomes. Am I correct? So you go to
Yes.
other incomes. So the first thing when you are consolidating, you go to your trial balance, look for who are those other incomes. So which means we should come here and look for who are those other incomes. Right, so we are here. So other incomes we have 28,800 plus 6,500. Those are the other incomes that we have. Then when you have your other incomes like that, then you come to your notes. What is in the notes that is going to affect other incomes? So which means here I saw the intra-group interest on loan is going to be eliminated from other income. Then we also have the management fees is also going to be eliminated from other incomes. Right, so let's just take those. I think we should also look at in those other incomes, there might be also other figures, but let's take those ones first. So which means the first thing is to go to a trial balance, you take everything. So that is there, that is 28,800 plus your 6,500. Then the intra-group interest is eliminated, so you are going to subtract it. The management fee is an intra-group transaction, then you are going to minus it again. Then what else do we need to, what else goes to other incomes? I think we still have what? Anything that we can, that normally goes to other incomes. Let's just check from our question. We have took the intra-group management fees and the interest. What else normally goes to other incomes? When we receive dividends, they go to other incomes. So the dividends that were received by the parent from the subsidiaries, we must eliminate a proportion. Remember here we eliminate the proportion. So which means we need also to do a calculation. Let's check on here. How many shares were acquired and how many shares are there. So which means here we need to do a calculation again. So here on the first one, we're going to have they acquired 40,000 ordinary shares. You need to calculate the percentage of interest here. Then here they acquired 15. So which means you just come here and say 40,000 over 50, then that one over 25. So it's going to be 40,000 over 50,000 times 100. This one is going to give us 80%, am I correct? Then we have 15,000 over 25,000. Three here is 5 here is 3, 5 here is 5. 3 over 5 is 60%. So that those are the percentage of interest. So which means here we are going to take 80% here, and here we are going to take 60%. So that's there on dividends. So which means 80% is an intra-group transaction. So we need to eliminate it. So we take it out. So which means here we are going to eliminate intra-group dividends. So I'm going to say minus 6,000 times 80%. How much are we going to have there? 4,800.
4,800.
So this one is an intra-group dividend. Then we still also need to minus the 10,000 times 60%. So it's going to be 10,000 times 60%. So I'm also going to minus 6,000. Right, so these are the other incomes. What else can go to other incomes? Right, so here, if you check, we don't know whether we're going to have goodwill or gain on bargain purchase. So for now, let's just do whatever we can do. We can leave it like that until we calculate the goodwill or the gain on bargain purchase. So let's leave it like that. So from there, from other incomes, what else do we need? Other expenses, am I right? We need to go to other expenses. So which means we come here, we take this one, and this one. Then we adjust by anything in our notes that can adjust. So other expenses, we are going to adjust them by who goes to other expenses here in our notes. This one will not go to other expenses. It will go to finance charges. And what there's management fee. Yeah, this one is the one that has to go to, is in other expenses. We should check it out from other expenses because it's in other expenses. So which means we are going to add, then subtract 10,000. I don't know if you guys are following what we are doing. It's not very complicated. Group accounts understand the double entry. So which means every time when you are the first thing that you need to understand is, what do I have to eliminate first? Because remember, in our consolidation, we say eliminate common items. Then after eliminating common items, then you combine the remaining items. This is what we are doing. We're eliminating the common items here. So which means we now combine the remaining items after eliminating the common items. Especially if the acquisition method is, you just need to understand this thing of who are the common items that need to be eliminated first. And so after other incomes, we have other expenses. The most important thing is to understand what is happening. You can't claim this. Understand what is happening. Even when you are in the exam, if you understand what is happening, the moment you are reading that scenario, you know how to treat these transactions. You know where they go and how to treat them. So that's why I always say in FAC needs more understanding than memorizing it. Because if you memorize, it becomes a problem to apply it. Right, so let's look at other expenses. It's going to be 88,000. We leave out this one because we don't know. Remember, we say gain on bargain purchase will come here under other income. So we don't know whether we have gain on bargain purchase. So we're going to say plus 35,000 plus who else? Other expenses plus 45,000. Then we minus the management fee. Do you see the management fee is the double entry here? We eliminate it from other income because the other party receive it. So we take it out from the other income. Then now, the other party who is taking it as an expense, we also have to eliminate it from there. So that's basically what you do when you are doing it's a double entry. If you take it out, the first thing is to trace where did it go. There was a management fee, so which means the receiver took it to other incomes. And the one who paid it is to charge other expense. So when you eliminate, you need to eliminate both. That's your double entry there. Right? Other expenses. What else can come to other expenses? I think this one we can have a figure for this one. There is nothing else that we need to have because income tax is going to be down there. So let's look at how much is going to be the other expenses here. It's going to be how much? This one, 158,000. Am I correct? Other expenses.
Yes.
Right. So we are done with other expenses. And from other expenses, where do we go? We need finance charges. I just want to show you a quick so that when you are in the exam, you need to this comprehensive income. You can do it before you do other calculations, so that you also save time. So you have you need your finance charges. Your finance charges will go first to your statement of the trial balance itself. So let's go to the trial balance and see under finance charges what is there. Okay. Finance charges, we only have 5,000. So you start with what is in the trial balance. Then you look at what needs to be eliminated. I think that other 5,000 must be eliminated. The intra-group transaction, this one. So it must be eliminated from finance charges. So which means in our finance charges, we are going to say 5,000, that's from the trial balance, minus the intra-group transaction, which needs to be eliminated. So finance charges are going to be nil. Then after finance charges, what are we going to have? We have profit before tax. Right, our profit before tax, we cannot have it now because we don't have this figure. So we can leave it like that. Then you can go, we say profit before tax, which means we need income tax expenses. So we go again to our trial balance. Our income tax expense is here. It's 77504, 18340, and 16660. That's our income tax. Then when we have your income tax, okay, let's just write them down. Then I'll show you uh, how to adjust that figure. That you need to adjust it with this figure. Your income tax is going to be adjusted by, where is that at here? When you eliminate this intra-group profit, it's going to reduce our profit. When it reduces our profit, what is going to happen to our tax? So it means our tax is also going to go down. So this is the figure that you need to adjust your tax. So which means your 3,000 times 27 is what is going to reduce your income tax expenses. Because the moment you reduce your profit by 3,000, it also means you are going to reduce your tax by 3,000. So that's an adjustment that you are going to do on the income tax expense. So which means here we're going to have 77,504 plus 18,340 plus 16,660 minus, so this is now your 3,000 times 27%. How much are we going to have there?
$810.
810. So which means you are going to minus 810. We're going to minus 810. How much are we going to have as our income tax expense? We add these three, then we minus 810.
It's
18,
111,694.
111,
11,694.
694.
Yes.
So this is going to be our income tax expense. So here we have a gap here. After income tax expense, what are we going to have? We're going to have profit for the year. We cannot have this because we don't have a profit before tax. We can leave it like this. After profit for the year, what are we going to have next? Other comprehensive income. Am I correct? Other comprehensive income. So which means here we are going to have other right? And then after other comprehensive income, we are going to have total comprehensive income for the year. Right? After total comprehensive income for the year, what are we going to have next? We're consolidating here. So after total comprehensive income, what are we going to have next? We're going to have total comprehensive income attributable to who we attribute it to owners of the parent and who else? Non-controlling interest. Right. So this is how it will look like. So which means we need the figures for here, 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 and here, and here, and also here on the other incomes. Profit before tax, we need to finalize there. Then other incomes, we need to see whether we have goodwill or we have gain on bargain purchase. So let's start from there. But I think we need to do the analysis now because we'll need a lot to bring in here. So let's do the analysis for the two subsidiaries so that we can fill in whatever needs to be filled there. But at least you already have something. You see, you already have something that you have done. So which means in the exam, if it is a consolidated statement of profit and loss, I don't start with those calculations. I will start to fill in whatever I can have, whatever figures I can have, so that even if I don't finish and submit something like this, I know I'm going to get something. Because if you start with calculating, then at the end of the day, you won't be able to fill in here. They won't give you those marks now. Right, so this is how it will look like. So which means now we need to do the calculations. I think we should do the analysis of owner's equity. So this is going to be our calculations. So let's start with our C1, analysis of owner's equity. This analysis, to be honest, me, I don't like it. It's boring. It's something that this calculation, but like here, I was trying to figure out how we can come up with figures there. Without the analysis, it's going to be a problem. But this thing is always tiresome. It takes a lot of time. Of owner's equity, because even if we calculate gain for bargain purchase, but we still need here what belongs to NCI and what belongs to here. We can only get it from the analysis. So that's why we should have to do it. So which means there we have to do analysis of owner's equity, it's not a must that you must do the analysis. If you have any other way of doing your calculation, showing your calculations without the analysis, you can show your calculations as long as your calculations can be understood by the person who is going to mark. So in our analysis, we are going to take for Crow and Berry. So let's start with Crow. They acquired control by acquiring 40,000 ordinary shares in Crow Limited when the retained earning of Crow Limited amounted to 349. The assets and liabilities of Crow Limited were fairly valued at acquisition. How much was the investment in Crow Limited? These are the three things that you want at acquisition. The investment is 325. That's the cost price or the consideration that was given. Then here you need to calculate the value of equity which was purchased. The difference between the value of equity and the amount of consideration that was paid is going to determine whether there is a goodwill or a gain on bargain purchase. So that's how you determine what happened at acquisition. So here we want Crow is 50,000. That's the equity. And remember, Crow is 80%. The percentage of interest in Crow Limited by the June Limited group is 80%. Those are the things that you need in your analysis. So let's look at where do we start? Right, let's quickly do the analysis. This is one of the things that takes a lot of time. Then we have 100%. That's the total. Then the June Limited group. The June Limited group owns 80%. That is, we need at acquisition. Then we need this since acquisition. Then we need the NCI. So the NCI is going to be 20%. Right, so we want to look at what happens at acquisition. At acquisition, we want to determine the value of equity that was purchased. So we have the share capital of Crow Limited. It's 50,000. Then the retained earning at acquisition, it's so this is the value of equity. So the reason why we want this is we want to determine when they purchase, do we have goodwill or gain on bargain purchase? Because the difference between the value of equity at acquisition and the consideration that was paid is going to give us goodwill or gain on bargain purchase. So here what I'm going to have on 80% of 50 is going to be 40 here. Then here, how much are we going to have here? 80% of 349 is 279,200. Right, then we add the 2 plus 40. How much are we going to have? 319,200. Then here, if we add here, how much are we going to get here? It's 50 plus this one is going to be 399,000. Right? Then what else are we going to need here? We want now to look at if we have goodwill. So let's look at the consideration that was paid. So let's come here and say consideration. How much was paid by the June Limited Group? 325. Ne? Let's check. Let's just double check. So the June Limited Group has got an investment in Crow Limited of 325. So that's the consideration which was paid, the 325. Right, so this is going to be 325,000. So what is going to happen here? Are we going to have goodwill or gain on bargain purchase? Are we having goodwill or gain on bargain purchase here? Are you guys there? This is the value of equity, 319,200. And this is what they pay. Is there goodwill or gain on bargain purchase?
Goodwill.
There's going to be goodwill, yes. So the difference between the two is going to give us goodwill. So we minus from 325,000. So our goodwill is going to be 5,800 here, right? Then 5,800 here. Then we add, it's going to be 404,800. We still need here. What belongs to NCI here? Here is 10,000. Then here, what belongs to NCI? 349 minus 279, 200. Are we guys lost? Are you guys lost? If you are lost to something, this is class time. Don't hesitate to bring us back, because the main purpose of having the class is for us all to understand. So if you are lost anyway, whatever we have been doing, it's better for us to do that small and everyone understand whatever we have done than to say we have done 5 long questions and people didn't understand them. So don't hesitate to ask if you are lost, so that you understand. Then tomorrow when you apply, it's going to be easy on your side. Right, so this one is going to give us what belongs to NCI on the retained earning. We subtract this from here. How much are we going to have there? 69,800. Right, so so what is going to be our what is going to be our here? What figure do we want here? We want the NCI. I think that's the only figure that we need. So which means it's going to be 69,800 plus 10,000. So it's going to be 79,800 here. That's the NCI. Then 79,800. Remember, they measure NCI at the proportionate share of the acquiring net asset value. So we only have goodwill for the parent. If they were measuring at fair value, you could see that we're going to have goodwill for NCI here. Right, so there we are done. What do we do next? This is what happened at acquisition. What are we going to do next from what happened at acquisition? But you got your question and look at here. This is what happened at acquisition. So you need to look at when did the June Limited Group acquired the Crow Limited Group. They acquired it on 1 April, and we are doing our consolidation on 31 March 2017, which means since 1 April 2015 to 31 March 2017, Crow Limited has been operating. So there must be something which they make from that day. So you come here and look at here. This is since acquisition to the beginning of the current year. So the current year starts on 1 April 2016. So you look at the retained earning of Crow Limited since acquisition to the beginning of the current year is 249,000. Then at acquisition, it was 349,000. The difference between these two is what was earned by Crow Limited since acquisition to the beginning of the current year. Because this is what was there at acquisition. Then this is what the 249 is what is there since acquisition. So which means this is what they've earned since acquisition. But in our case, what are we going to have here? 349 at acquisition. We have 349,000 at acquisition. Then since acquisition to the beginning of the current year, we have 249,000. Are we going to share a profit or are we going to share a loss here? Are you guys there? Are we together there? Right. I will not understand whether you guys are understanding if you are just quiet. That's the challenge. Right. So here we are going to have since acquisition to the beginning of the current year. I showed you when do you have this column for sin. If the acquisition date and the year of consolidation are different, then it means you are going to have a since acquisition to the beginning of the current year. So in our case, we are going to have a loss. So it's going to be accumulated loss. So the loss is going to be, they now have 249 from 349,000. So there is a loss of 100,000. So you are going to share that loss. So 80% of 100,000 is going to be 80,000. So the loss that goes to the group is going to be 80,000. And the loss that goes to NCI is going to be 20,000. So that's there. Then from there, where do we go in our analysis? We go to current year. What happened in the current year? So in our current year, we need the profit for the year. We need to see what goes to NCI, what goes to the group in the profit for the year. So we come here and say profit groups accounts. Once you understand them, they are not that. The only thing is to understand the sequence. What exactly is happening? So that when you apply on your side, it's just like you are just taking information from the scenario and you know where to take it. So we want the profit for the year for Crow Limited. I think we have to do a calculation separate. There's too much here. We have revenue of 248 and we have other incomes and we have cost of sale of 149 and we have other incomes and we have finance charges and we also have what else? Income tax expense, which is 1834. So we need to do a calculation, a separate calculation for this one. So we're going to take revenue, then we take other income, we take cost of sale, we take finance charges, we take other expenses, we take income tax expense, then we can have our profit for the year. So let's do a C1 for profit for the year. No, it's our C2, C2. So we need to do the profit for the year for Crow Limited. So we say our revenue is equal to what? 248,000. Then cost of sale is going to be 149,000. Then what else do we have? We have the gross profit. What is going to be our gross profit there? 248,000 minus 149. It's going to be how much there?
99,000.
99,000. Then after gross profit, we have other incomes. We say 6,500. Then we have other expenses. Other expenses of the 5,000. Then we have finance charges.
Finance.
18,000. No, is it other expenses? Finance charges is 5. What is other
1,000.
income? Other expenses is 35,000, is that right?
Other expenses is 35.
Then finance charges
Yeah,
is
it's
5,000.
35.
Am I correct now? I mix my numbers. Other expenses is 35,000. Then
Yes,
finance charges
it's
5,000.
5,000. Yes.
Income tax expense is 18,340.
Hmm.
So it's going to be an expense again. Then we have profit. So it's going to be how much? We start from here. From here, we add this one, plus this one, minus this one, plus this one, minus this one. How much are we going to have there? So this one is going to be
47,160.
160. So we
Yes.
now have the profit for Pro Limited. So we can go to here. Okay, so we can come here and fill in. There's something that I'm still thinking of. Who made profit in the intra-group transaction? Yeah, that's what I was trying to figure out there. Who made profit in the intra-group sale? Let's check that one. That figure must also adjust. So during the year ended, Pro Limited sold. So Pro Limited is the one who made profit. So which means if Pro Limited is the one who made profit, you need to adjust Pro Limited's profit by this intra-group transaction. So which means the 3,000 should be eliminated, should be removed from the profit for Pro Limited, but always apply after tax, minus after tax. So which means here, we also have to apply that intra-group transaction here. So you can come here and say, so we say it's 47, 47,160. Then you adjust the unrealized profit here. Unrealized profit. So it's going to be your 20 over 120 times 18,000 times 0.73. How much are we going to have there? It's 3,000 times 0.3. 3,000 already have it. Times 0.73, 2,190. Am I correct? So it's going to be 2,190 here. So we minus it from 47,160. I don't know if you are together there. So 47,160 minus 2,190. How much are we going to have there? 1, 2, 3. 44,970. You only take this year if the subsidiary is the one who made profit on sale. If it was the parent who sold to the subsidiary, you're not going to take it to you. Then what are we going to do with this profit? You now share what belongs to the group. So what belongs to the group is 44,970 times 80%. So what belongs to the group is 35,976. Then what belongs to NCI minus 44,970. So what belongs to NCI is going to be 8,994 on the profit for the year. Right? That's there. What else do we need? We check here again if there are any dividends. Any dividends. Dividends paid by Crow Limited to the June Limited Group. So let's check from our trial balance and see what were the dividends that were paid. Is going to be 6,000 is the one paid. Then you also need to share. June Limited owns 80% here, so it means 80% are the dividends that are going to reduce the profit. So let's come and put it here. Right, so the dividends are 6,000, and what is going to be 80% of 6,000? We already did this one. We say it's going to be 4,800. Then what is going to belong to NCI? We minus the 2, then we're going to get 1,200. So that's there on dividends. Then what else do we have in the profit for the year? Let's check. Remember, we're talking of other comprehensive income. Let's see who owns the other comprehensive income. This mark-to-market reserve is owned by Crow. So we must take it to their analysis, the 3,920. We must take it to their analysis. So let's also take the 3,900 because it's owned by Crow Limited. So let's bring it there. So we have other comprehensive income. We say it's how much again? I forgot the figure. Anyone who has the figure for the comprehensive income? We say it's how much? Let me just go there quickly. So we say it's 3,920. So this is going to be 3,920. What belongs to here? You multiply by 80%. It's going to be 3,136. Then what belongs to NCI? You minus the 2 minus 3,920. It's going to be 784. So after everything, I think the most important column that you always make sure that you add is this one for NCI. So let's work the total column for NCI. So our NCI column is this one. So which means we're going to start from 79,800. Let me just take it as well, 79,800. Then we go to since acquisition. Here there's a loss. So we're going to subtract the 20,000. Then we go to profit for the year. We add 8,994. Then we go to who else? To the dividends. We subtract that intra-group dividend. So I'm going to subtract 1,200. Then we go to other comprehensive income. We take 384. We add 784, sorry. 784. So this is going to be our NCI. It's going to be 68,378. When you do your statement of change in equity, this must be the value of your NCI. Even when you go to do your statement of consolidated statement of financial position. Right. So let's quickly do the analysis for Bear Limited. Let's quickly do the analysis for Bear Limited so that we can finish our comprehensive income. So our C3 is going to be the analysis of so our C3 analysis of owner's equity of who is here is going to be Bear Limited. Right? Where do we start? We just do like what we did. So that is going to be our 100%. That's the total. Then we have Bear Limited, June Limited on 60%. So we come here and say June Limited 60%. Then we need our sins and NCI. So here we need an appreciation. Right, so that's there. So let's see what happens with acquisition. Right, so let's go to our question and look at what happens to Bear Limited at acquisition. very limited. So June Limited acquired control on 1 April 2016. Do you see the year? It's 1 April 2016, and our consolidation is 31 March 2017. So what it tells you there is there is no since acquisition to the beginning of the current year because the acquisition was done in the current financial year and the consolidation is done in the current financial year. So always look at the date of acquisition and the date of consolidation so that you know, am I going to have what was accumulated since acquisition to the current year. So in this case, we don't have since acquisition to the beginning of the current year because the acquisition date falls within the current consolidation financial year. Right, so that's basically there. So we are not going to have since acquisition. We're only going to have what happened at acquisition and then current year acquisition. Right, so let's check what is happening here. They acquired 15,000 ordinary shares, and the assets and liabilities were fairly valued at the date of acquisition, except for the land. A stone appraiser valued the land at 300,000. This was 54,847 above the original cost. So the land was revalued. So here we're talking of revaluation surplus. This is where that other, this is also going to form other comprehensive income, the revaluation surplus. So it's 54,847 is going to be other comprehensive income. Then let's look at the share capital at acquisition. You see here there is no retained earning at acquisition, but the trick is on this date here. So if you check that date now, let's go to here, retained earning on 1 April. So which means the retained earning of Bear Limited at acquisition is going to form the equity of Bear Limited at acquisition. So that's basically there. So here we're going to have this retained earning plus the share capital plus the revaluation of the land. We're also going to have the revaluation of the land. So let's go ahead and fill in there and see. Right, so which means here at acquisition we're going to have share capital 25,000, which is 25,000. Then retained earning. Our retained earning is 260. Then we have a revaluation surplus. Our revaluation surplus is 54,847. What are we going to do with the revaluation? What are we going to do with the revaluation surplus? We need to take into account What are we going to subtract? We need to subtract something here on the revaluation surplus. We can work it in here. We are going to subtract what? Minus 54,847 times 0.73 times 80%. What are we going to minus there? So it's going to be 54, 847, 847. Then we say times 0.73 times 80%.
$11,847.
Sorry? 11,000.
847.
Okay. You are saying, I'm getting, why is my figure? I'm getting 32, 030. How did I do it?
I'm also getting that.
Minus 60.
Everyone
I was
was
calculating,
getting
I was calculating the second
the second line.
amount.
Or the
Yeah.
second line.
Yeah.
Okay.
55, 7.
Right. So which means here we have what we want is, remember here we need to take out the tax, and the tax that we need to take out, we should also include the capital gain tax. So when we calculate that figure, how much are we going to have? I think we want to subtract, which means here we should not put 0.73. We should put what here? We should put 0. What? 27. Am I correct? Yeah. That's the figure that we are going to subtract. 54,847 times 0.27 times 80%. So that figure is the one that we subtract from 54,847. So how much are we going to have here?
43,000.
43,000. So that's the value of equity, right? So if we have this, then remember it's 60%, then we need 60% of here. You multiply 25,000 times 60, it's going to be how much there? This one is going to give us 15,000. Then when we multiply, this is 260. When we multiply 260 by 60, how much are we going to have there?
156,000.
So this one is going to be 156,000. Then when you multiply by 60,
25,800.
then this one is going to be 25,800. Right, then what else do we need now? We need here. So we need now the value of equity, 15 plus 156 plus 25, 800. How much are we going to have there? 196 800 here. Then what is going to happen? We need to determine whether there is goodwill or gain on bargain purchase. So which means here we must have our consideration and NCI. Consideration is the amount that was paid. So you take the cost of the investment. So consideration and NCI, we go to our question and look at the consideration. So our consideration is going to be here, it's 195,500. That's the consideration. So it's going to be 195,500. What are we going to have here? Are we going to have goodwill or gain on bargain purchase? What are we having here? Is it goodwill or gain on bargain purchase? This is the value of equity which was purchased. This is what they paid. So which means they gain here. They purchase at a discount. So they gain. So that gain is the one that we're going to take to other comprehensive income. So it's going to be gain on bargain purchase. If you understand groups are very interesting. They are very, so what is going to be the difference between the two? We are going to have 300 here. We are going to have 1 here. So it's going to be 1,300. Let's look at the total for here. It's 328,000. So I'm going to take out 1,300 here. So it's going to be how much there? 326,700. Right? Then what we want now is the NCI here. So it's 10,000. Here is 10,000. Then here 260 minus 156,000. How much are we going to have there? 104,000. Am I correct? Then this figure goes with this one. So it's going to be 43,000 minus 25,800. It's going to be 17,200. So we add the 3 and we get our NCI. It's going to be 114 plus 17, 131, 200. So this one is going to be 131, 200. That's our NCI. Remember, we say we don't have since acquisition column. So we are now going to what happened during the current year. So in the current year, you always look for profit for the year. The profit for the year, right? In your profit for the year, you can now go to here. You can calculate the profit for the year. Let's see if we can calculate it inside or it needs a separate calculation. Right, the profit for the year for Bear Limited is going to be 190 minus cost of sale of 85, other expenses, and income tax expense. I think we can do it inside. That one is not going to be a problem. Let's just do it inside there. So it's going to be profit for the year. So we start with the revenue, which is going to be 190 minus 85,500 minus 45,000 minus who else? The last one, 16,660. So what is going to be oh, look at what I did. I must put it in this column. You see, when you are trying to be in a hurry, that's when you make silly mistake at the end up. Right, so I wanted to do the profit for the year. So we can say 190,000 minus 85,500 minus 45,000 minus 16,000. So how much are we going to have as our profit for the year? One hundred
42,840.
42,840. Then we go to this column. This is for at acquisition. We go to since acquisition. What belongs to the group from the profit for the year? We take 42,840 times 60%. So it's going to be
25,704.
25,704. What belongs to NCI? We subtract these two. Then we get what belongs to NCI. Minus 42. Yes.
17,136.
17,136. Then we don't have other comprehensive income. So which means we'll go to where? Dividends. We look at the dividends that were paid by Bear Limited, the intra-group dividends from Bear Limited. So we check from our trial balance to get the intra-group dividends. So let's look at dividends. Bear Limited paid 10,000. So that's the dividends that were paid. Right, so which means here we come and take the dividends. So there's 10,000 here. Then 60% of 10,000, how much are we going to have there? It's going to be
6,000.
6,000 here. Then what belongs to NCI is going to be 4,000. Right? Then the total that is important, even if you don't have time to do the other totals in the exam, make sure you do your NCI total, because it's the one that you are going to need when you go to other consolidation. So this one we need the total for NCI. So let's start and check. We start from here, 131, 200. Then we add for profit for the year, which is here. We add 17. Then we minus 4,000. How much are we going to have as our NCI there? We are going to have 144,336. This figure, the reason why I always want this total is because we are going to use it when we do our consolidated statement of financial position. You will need this figure. So having it now is going to assist you. But anyone with a question here, remember we're doing our calculation here. So which means now we can take whatever we want to the profit and loss. We are done with where is that gain on bargain purchase? It's 1,300. So we can now take it to our calculation, to our profit and loss. So we were saying other income, then we can now say plus 1,300 here. That is going to be your C3. So let's have the figure here for other incomes. Right, so we're going to have how much? So we're going to add 28,800 is other income, 28,800 plus 6,500 minus 5,000 minus 10,000 minus 4,800 minus 6,000 plus 1,300. How much are we going to have here? So this one is going to give us 10,800. Then our other expenses, we're done with them. We're done with other expenses. Then what else do we need? So which means here we need the profit. That's all. We need the profit before tax. So let's come here. Where are we? We start from here. We add 536,500 plus 10,800 minus 158,000. It's going to give us how much? 389,300. That's the profit before tax. So our profit before tax here is 389,300. Then from there, we minus the income tax, which is minus 111,694. Is 111,694. So our profit for the year is going to be 277,606. That's our profit for the year. Then what is going to be our other comprehensive income? What is going to be our other comprehensive income? We go to here. We take other comprehensive income. Our other is 3920. So 3920, 3,920. So what is going to be our total comprehensive income for the year? We add the 2 plus 3,920 is going to be 281, 526, right? That's our other comprehensive, total comprehensive income. Then you come here and you say total comprehensive income attributable to owners of the parent. You are now going to say 281, 526 minus the NCI. You still need to get 281, 526. So you go to your analysis. Now we have our everything. So you go to your analysis. The profit for the year that goes to NCI is what you are going to subtract from here. So you just come here. Where is our analysis? They are down, sorry. So the profit for the year that has gone to here is 8,994. Then you go and check the other one from Berry Limited. The profit for the year that goes to NCI is going to be how much here? 17,136. It's here. So you go in and fill in there. So we are here. So you now say 17,136 plus the other NCI is 8,994. How much are we going to have there? 17,136 plus 8,994. So you are going to subtract 26,130. So you subtract here 26,130. So that's what belongs to the owners of the parent. So 281, 526 minus 26,130 is what belongs to the owners of the parent. How much are we going to have there? It's 281, 526 minus 26,130. I'm getting 255,396. 255,396. If we add these two, they must give us this up. Then it will be done with your comprehensive income. So this is how you should do it in the exam. You can start by whatever does not need a calculation. And remember the calculation that we did, we still need to use it. There's a lot of areas when we go to the statement of change in equity, we still need it. When we go to the statement of financial position, we still need it. Right, so in our next class, we'll finish off this question. I want us to finish off so that we can look at anything else that can assist us. So since we now have our calculations, I think D, oh, C and D are not going to be a problem because already we have done the calculation. Because when we come here, we just take from the total comprehensive incomes to the statement of change in equity. We now have all those figures. The same applies to here. So in our next class, we'll finish off C and D. You can go through them during your start time so that you can see where you get lost. Unless if you guys have any question or anything, I think this is the end of today's class. Right, so you can go through even this question again alone. Unless if you guys have any question, I'm gonna end the class now.
Thank you, love, ma.
Thank you.
Okay, I'll send the recording and the calculation so that you can go through.
Thank you.